What's up, y'all? It's T, aka Stock Trader T, and today we are going over trading terms. All right. So understanding trading terms, right? Common trading terms. Let's start with bid. All right. The highest price a buyer is willing to pay. So I want you to understand something. When you're purchasing a contract, bidding is somebody, you more than likely, trying to purchase the contract for whatever price you're bidding at. For example, if someone's selling a vehicle and they're selling it for $1,000, and I'm coming in with a bid of, hey, I have $800. So a bid is simply what you're choosing to offer the person. All right. Next thing, ask. The asking price is the lowest price a seller is willing to accept. Meaning, if the vehicle, once again, is $1,000 and they say it's non-negotiable, that is the asking price for the contract. All right. So the next thing, the spread, the difference between the bid and the ask price. So I want you to understand the spread is basically if the bid price was $100 and the asking price was $99, the spread will only be $1. Make sense? It will only be $1. All right. Next thing, volume, the number of shares or contracts traded over a period of time. So I want you to understand something. When I go purchase contracts, I'm looking at volume. So basically what I'm looking at is which contract has high volume, meaning that if I get this correct strike price with high volume, a lot of the money is flowing to this strike price. So volume is a great indicator to see what strike price to pick. Next thing, volatility, the amount of price movement over a given time. So meaning volatility, you want volatility inside of the market due to the simple fact is you make money based off how much something moves. So if I sit right here and have a $100 stock and its ATR, which is considered an average true range, is $3, then it goes outside of its ATR to $5. This is a lot of volatility inside of the market. You usually catch a lot of volatility around news time, earnings, things of that such. Okay. All right. Acronyms you'll see often. P&L. A P&L stands for profit and loss. All right. Simply how much you make or how much you lost. So whenever you're asked what's your P&L for the day, it's your profit and your loss, how much you made or how much you lost. Okay. The next thing, ROI, my favorite thing, stands for return of investment. Meaning, for example, if I put in $100, how much ROI did I get? If I sit right here and make $50 off the $100 that I invested, then I have a 50% ROI. Okay. ROI stands for return of investment. All right. ATH stands for all-time high. Shout out my dog Ace. That's the name of his brand. But all-time high basically stands for ATH, meaning if this stock has peaked at an all-time high, it usually rejects in that area or you'll see a slight pullback, but ATH stands for all-time high. All right. Next thing, EMA /SMA, an exponential simple moving average, right? And EMA stands for exponential moving average. It's basically an indicator that allows you to see data based upon previous trading days, all right? And also a simple moving average is basically showing the moving average of how the market moves on average with the correct volatility, all right? So those are considered indicators that you can possibly use to trade with. All right, the next thing, TP. TP stands for take profit. Anytime if you're in a Discord, you're in a chat, you're on a live call and they set right here and they have a TP, that's simply a take profit. Sometimes people put TGT, that stands for target, but for this example, a TP stands for this is the area where you're going to take profit. All right. Next thing, order types. Market order executes immediately at the best available price. So I like to think of it like this, right? A market order simply means, hey, I don't care what price it is at, let me in. Understand that the stock market is constantly moving. It's not going to stay at $100. It may fluctuate. So a market order is saying, hey, whatever price it goes to, let me in immediately, and then I will be in the trade and I'll ride the trade through because I believe this is going to go in my direction. All right. Next thing, limit order executes only at your specified price or better. So a limit order means let me at this certain price. So let's say the stock is at $100 and I say, hey, once this stock gets to $101, I want you to put me inside of the trade. So I'm placing a limit order at $101 and my contract will execute once that price is hit inside of the market. All right. Next thing, a stop loss order sells your position automatically if the price drops to a certain level. So a lot of times you need to have a stop loss. So when I'm trading futures, what I do is, let's say I factor in pullback. So if I go down $1,000 on a trade, that's where I will set my stop loss at based upon my contracts. So if I say, hey, if I lose $1,000 to get me out of this trade, this is utilized for a lot of people who want to walk away from the screen, or some people who's trying to remove the emotion, the roller coaster of it all. Okay. So a stop loss or an SL. Okay. And here is a couple more terms that's not on the screen. So let's talk about a call. Make your hand like a cell phone. A call is basically saying that the stock is going to go up. So like you're picking up the phone, right? A put, like you're putting down the phone, is basically saying that the stock market is going to go down. So for example, if the stock was worth $100 and I make a call, I'm saying that the stock is going to go up. If the stock reaches $100.01, guess what? I'm profitable. A put, like I'm putting down the phone, is also a sell. It means if the stock is at $100 and it goes to $99.99, guess what? I am now making money because the stock has went in the correct direction that I said. Two other things, right? A bear and a bull market. A bull market means that the stock is going up. The reason being is because a bull uses his horns and attacks upwards. So they call that a bull market. A bear or bearish means that the market is trending down. The reason why they call that a bear market is because a bear stands up and attacks going down. So a bear market basically means that the stocks market is trending down. A trend in the market means what a trend means it's going in one direction. So a lot of traders follow the trend. So if the market is trending up, then they'll get in calls because the market is trending up. If the market is trending down, meaning multiple candles and are still fluctuating in a downward trend, then people will get into a put or a sell based upon the market. And finally, consolidation. Consolidation is basically where the market stands between price and it just moves sideways. There's actually plays in consolidation for a big explosion to the upside or the downside. You just have to pick when the proper entry should be. So consolidation means that it's moving on sideways. All right.